Mr. Santos, can you hear us?
Yes, can you hear me?
Yes. Yes.
Let me just locate the agenda. I'm
Okay,
going to be rolling.
sounds good.
Apologize for being a few minutes late. All right. All right, ready to roll.
Okay.
Good morning. I call it to order the Equity Public and Private Committee of the Board of Investments. Today being Wednesday, November 9th, it is 8 a.m. Madam Secretary, would you provide us with a roll call as well as any announcements in preparation for the meeting?
Thank you, Mr. Santos. This meeting is being conducted as a virtual and an in-person meeting, so I will do a roll call of the trustees to confirm attendance. Ms. Greenwood? Mr. Knox?
Good morning, I'm here.
Thank you. Mr. Jones?
I am here.
Thank you. Mr. Santos?
Here.
Thank you. Mr. Green? Mr. Kehoe? Mrs. Jones? Ms. Sanchez? Mr. Kelly? Okay. Staff participating in the meeting include the following: CIO John Grable, DCEO Louis Lugo, Chief Counsel Stephen Rice. Investment staff include Christopher Wagner, Esme Delbos, David Simpson, and Ronaldson Conwa. Consultants include the Makita team, Stepstone team, and the Alborn Group. Trustees, please use the Zoom chat option to be placed in this queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
Great, thank you very much. Do we have a quorum?
Yes, we do.
Okay, good. So the next item on the agenda is approval of the minutes for July 13, 2022.
This is Keith. I'll move approval.
I will second that. Any changes, corrections? Hearing none, roll call, please.
Okay. Ms. Greenwood? Mr. Knox?
Aye.
Thank you. Mr. Jones?
Yeah, aye.
Thank you. Mr. Santos?
Yes,
Okay, the motion passes unanimously.
thank you. The next item is public comment. Do we have any requests for public comment?
We do not.
Great, thank you. Non-consent items, subsection 8. The growth functional category biannual structure review. Staff, you have the floor.
Thank you, Chair Santos, and good morning, members of the committee and trustees. Before I start, I want to thank Mel Sau over in the investment office who's running the charts today for doing what we'll see is be a good job. Next, I'd like to provide some context before we begin the presentation. The most important element of LACERA's investment program is the strategic asset allocation. Once the allocation policy is set, the next essential program piece is the plan to implement each component of the policy. This implementation is currently done by establishing and adhering to board-approved structure reviews for the 4 functional asset categories: growth, credit, real assets, and risk reduction mitigation. The purpose of the structure review is to establish a framework from which staff operates. and it identifies initiatives and key themes for the upcoming 2-year period. As you will hear throughout the presentation, the structure review model is working. We think it's working because it brings a focus to each asset class in the portfolio. As examples, within global equity, the portfolio performance has improved since the last structure review, which you'll hear more details about shortly. For private equity, the structure review has been a conduit for staff to improve the intentionality of the portfolio through the co-investment and secondary program, with more on that to come too. Lastly, both Makita and Stepstone, who have representatives here today, each provided memorandums which are included in your package that affirm the structure review. Page 3, please, Mel. The growth category includes global equity, private equity, and non-core real estate. However, non-core real estate is not included in the structure review because it is covered in the real asset structure review alongside core real estate. The role of growth in the portfolio is to provide market beta through global equity and substantial outperformance at an acceptable level of risk through private equity. Next chart. The initial structure reviews for private equity and global equity happened at the end of 2018 and the beginning of 2019. It wasn't until after the establishment of the functional categories in early 2019 that the growth category was created. Not counting the mid-cycle growth structure review in July 2020, after COVID started, this is the second growth biennial structure review. Next chart, please. Growth makes up approximately half the trust assets, as shown on the pie on the left in the colored section. As you can see on the right, the growth portfolio is under target weight, mostly due to an underweight in non-core real estate assets. Next chart, please. Here's a glance at the growth portfolio's industrial sector exposures. Most exposures are at or near the market weights, apart from information technology, which is overweight and highlighted. This overweight is a result of the return potential many private equity managers see in the information technology sector. Next chart, please. The growth portfolio annualized excess returns for all periods measured, which is highlighted, has been positive. The outperformance has been driven by both global equity and private equity exceeding their benchmarks. Next chart, please. As investors, it's important for us to listen to what events are happening in the marketplace and the risks they bring to the portfolio. Here we've identified several risks and uncertainties currently in the marketplace. To manage these risks, our investment themes are about sticking to and trusting our processes and adhering to our global market diversification objectives. Next chart, please. And finally, staff will continue to evaluate ESG risks and opportunities in our due diligence work and assessment of managers, and advocate practices in line with LACERA's corporate governance and stewardship principles. Now I'll turn over to Ron and Esme to take you through the global equity portion of the presentation.
Thank you, Chris. Good morning, Chair Santos, trustees. Now that we've set the tone for the growth portfolio, let's move to a review of its largest component, which is global equity. My commentary is going to focus on overarching structure, and we'll have Ron provide some details on the composite. Starting with slide 11, Mel. Just a reminder that the purpose and role of global equity is to provide global equity beta to the total fund while meeting or exceeding the program benchmark, which is the MSCI ACWI IMI index. The allocation pie on the right-hand side in the middle of the page provides the composition of the $22 billion allocated to global equity in its sub-strategies. We see that 64% is invested passively in a MSCI ACWI IMI index fund, roughly 20% is in factor strategies, and the balance of the 14% is in active strategies, which does include the emerging manager program allocation, which stands at slightly less than 0.5%. Importantly, all strategies are within their policy range. And last month, the board voted to hire 2 emerging manager program providers and increase the emerging manager policy range from 0 to 5% to 0 to 10%. We mentioned that because we anticipate that the active subcategory weight will be closer to its target once those program managers are onboarded. The most recent strategic asset allocation did reduce the global equity weight from 35% to 32%, and we currently stand at 31%. That 1% that we are underweight translates to roughly $740 million. On the next slide, we go one level deeper into the allocation of the portfolio, and we review weights by region, market cap, as well as the emerging manager program we just spoke to. The table highlights that the portfolio is index aware with weights plus or minus 5 of the benchmark. And if we focus on the last column labeled difference, we can see that the sub-strategy exposures are within board approved ranges. And I would note that any deviations stem from active managers positioning versus their respective benchmarks. Next slide, Mel. As Chris had mentioned, since the last structure review, we have worked with the board to actively refine the structure to more closely align to its objectives as well as total fund initiatives. This page is a timeline that highlights the reviews since the last structure review and the board actions taken. Now, notably, the trustees have approved 8 actions, which are highlighted in teal on this page, to enhance the global equity program. And if we move to the next slide, we can see that there has been a marked improvement in portfolio returns since that last structure review. Now, by way of background, this is for newer trustees. Prior to the move to the functional categories, equities was not global equity as a composite as we know it today. It was 2 separate portfolios managed separately, the US portfolio and the non-US portfolio. So we used to have structure reviews for both. Now that we do have a combined composite, we note that it doesn't have as long as history as some of the underlying managers. And that also holds true for the subcategories, passive, active, and factor. Just wanted to give you that flavor because on the left-hand side of this page, we added a performance table. We lifted it from the previous structure review. It stated September 2020, and the composite at the time was underperforming. As we can see, all excess returns are in red. The team at the time had noted that there was an overweight to active US small cap managers with some strategies underperforming negatively, which had impacted performance. If we fast forward to the present, the table on the right-hand side shows returns as of August 2022. And we can see there's been an improvement in performance as excess returns have turned green. I will go into detail as to the returns. Yes, Mr. Kelly.
Good morning. I had a question on slide 11.
Yes.
I forgot to ask. You say that the most recent strategic asset allocation target was reduced from 35% to 32%, but yet the policy range in the first column is 25 to 39.
Correct.
What is the relationship between the 35 and the 39?
What is, I'm sorry, could you repeat
The
that?
relationship between the 35% and the 39%? You said the board reduced it from 35 to 32,
Yes.
but over here it says the policy went up to 39%.
Oh, I was speaking to the target allocation,
Oh, got it, got it, got it.
35% to 32%.
Okay, got it. Thank you.
Sure.
That's right. You read that. Thank
Oh,
you.
yes. Okay. So as I was mentioning, if we look at the performance table on the right-hand side, that's as of August 2022, we see that performance has improved. I will speak on more detail as to that performance in a couple of slides, but did want to mention, as I had mentioned previously, it is important to note that the performance improvement is mostly due to the changes that were intentionally implemented to optimize risk-adjusted return. And that includes terminating strategies that were underperforming or were no longer a fit for the portfolio, emphasizing manager relationships that enhance transparency as well as our beneficial rights to the total fund, and implementing an overlay program as a risk mitigant tool for the global equity portfolio, which Ron will cover on a later slide. Next page, Mel. Here we speak to the broad market environment that has underpinned our managers' performance. Chris went through some global themes earlier, but the commentary here is really dedicated to the equity markets. And broadly, the US markets have outpaced non-US, with large cap stocks leading the way. And within the non-US markets, the Ukraine war has really dominated country and sector return. We'd also note that emerging markets, because of that, has broadly lagged their developed market counterparts. With that as some market context, if we move to slide 16, here we go more in depth on the global equity performance. And as shown in the dash box, we have excess returns across different time periods, and they're all outperforming. We can see that on an annualized net fee basis, the portfolio is outperforming by 130 basis points at the 1 and 2 years, and 50 basis points for the 3 years and since inception. We also provide risk metrics, trustees, that exhibit that despite its short history, the portfolio has logged positive Sharpe and information ratios, and it's demonstrative of improved risk-adjusted return. The other note I would mention is that roughly 75% of our underlying managers have outperformed their respective benchmarks despite the challenging global equity environment. With that, I'll pass it on to Ron to speak to attribution, risk, fees, and provide some closing thoughts on global equity.
Thank you, Esme. This slide covers sub-strategy performance drivers. We provide attribution in 2 flavors. First, we wanted to compare performance versus their subgroupings, and that is shown against their weighted sub-strategy composite benchmark. Second, we wanted to also show how each of the sub-strategies performed relative to the broader composite benchmark, the MSCI ACWI IMI index. Looking at the dark blue bars, both active and factor managers surpassed their composite benchmarks. Active manager results were attributable to positive stock selection. The factor managers outperformed through the model's overweight to value and quality. Looking at the green bars, active managers lagged the broad benchmark driven by the overweight to non-US stocks, as US stocks outpaced non-US stocks. In contrast, factor managers outperformed because of the overweight to the US. We wanted to highlight LACERA's passive index strategy performance. Typically, a passive fund would perform in line with the index. However, as you can see below, the strategy outperformed by 70 basis points. This is driven by exposure to India and income recuperated from tax-free claims. The broad portfolio exceeded the index by 1.3%, as Esme mentioned. Moving on to the portfolio risk on the next slide, please. This graph shows each active manager's risk contribution relative to their weight within the portfolio. Overall, the individual manager active risk contributions are commensurate with their weight within the portfolio. As Esme mentioned previously, the cash overlay seen at the bottom of the graph is used as a risk mitigant tool and reduces overall portfolio risk. We can see highlighted in the blue circle that the cash overlay is diversifying away active risk. This is in line with the objectives to reduce tracking error and align portfolio exposures closer to the benchmark. Currently, the active portfolio is comprised of 11 managers. Important to note is that the number of managers will increase once we onboard the 2 separate account emerging managers. Once funded, staff will conduct a review of the active portfolio to reassess sub-asset and regional exposures. Next slide, please.
I have a question.
Sure, go ahead.
What percentage of the total global equity portfolio is indexed?
Repeat your
What
question.
percentage of the total global equity portfolio is indexed?
About 60%.
60%?
Yes.
Okay, thank
Just want to remind my colleagues that if you wanted to speak or ask a question, raise your hand, please. Please continue.
Okay, thank you. As discussed prior, the global equity was implemented to mitigate portfolio risk. It is used to rebalance portfolios' regional and market capitalization weights back to target when deviations exceed plus or minus 1% weights relative to the benchmark. Since inception of the Global Equity Overlay Program, The overlay has been additive, generating a gain of $57 million. Moving on to slide 20. In line with broad LACERA strategic initiatives to strengthen influence on fees and improve net of fee performance, there has been a reduction in annual fees. The chart on this slide shows that the global equity fees for the last 3.5 calendar years. The green bars are aggregate portfolio fees. The light gray bars show the fees for the active portfolio. Over the last 2 years, total global equity fees have been reduced by $1.3 million. This is really meaningful given that approximately 80% of the portfolio is in passive and factor-based strategies where we pay very low fees. The fee savings are a result of termination of managers with poor performance and organizational risk, transitioning away from strategies that may be inconsistent with LACERA's strategic initiatives, and fee negotiations with existing managers. We anticipate further fee savings when additional board-approved manager terminations exit the portfolio. Next slide. To summarize the global equity portfolio review, there have been a couple of areas that have helped the portfolio, including board-approved changes to the structure and outperformance of active managers versus their respective benchmarks. We also identified a few areas for refinement that we will discuss on the next slide in upcoming initiatives. Next slide, please. This slide breaks down the team's strategic initiatives by completed, in process, and upcoming. What we've accomplished to date are initiatives identified from the last structure review. Additionally, the team assessed the Global Equity Emerging Manager Program and finished searches, reviewed internal management, and implemented the overlay. In process, the team is continuing to integrate risk analytics into manager oversight, conducting annual contract compliance review, and further integrating DEI and ESG. As alluded to on the prior slide, we continue to look for ways to refine and enhance the portfolio. In the next several months, the team plans to onboard the EMP separate account managers, review the active portfolio once the EMP is funded, and lastly, conduct a portfolio risk analysis study. I will now pass the presentation over to David, who will cover the private equity review.
Mr. Chair.
Before we get there, is there any questions with regards to the public equity presentation at this point? Seeing none, Mr. Simpson.
Thank you, Mr. Chair. Good morning, trustees. And thank you, Ron. As an aside, Ron and I started at LACERA 10 years ago this month, so we'll celebrate our 10-year anniversary together. So thank you for that. On slide 24, just as a reminder, the private equity objective is to generate the highest performance in the portfolio at an acceptable level of risk and to be the primary driver of long-term fund total returns. For some perspective, at the growth structure review 2 years ago, growth as a whole stood at $29.7 billion and private equity at $6.9 billion. So the growth reflects both strong performance and private equity's target increase from 10 to 17% of the portfolio. On slide 25, as we look at private equity portfolio by strategy, we see that all strategies are currently within policy range. Focusing on the last 2 rows of the table, the outsourced co-investment fund of funds and secondaries has a market value of $1.7 billion. And with up to 30% of annual commitments allocated to our in-house co-investment and secondaries program, that has grown to $1.1 billion in market value. As the policy range for the strategy is 10 to 25%, and we currently sit at 21%, staff proposes to extend the upper boundary to 30% to ensure that we remain in policy during the period covered by the structure review. Upcoming slides will talk to the positive contributions generated by the in-house program on fee savings and performance. Slide 26 shows our over and underweights to countries in dollar amounts relative to the benchmark weights. The combined overexposure to the US and China is $1.8 billion. And to the right of the dotted line, You can see the countries that we are most underweight to, led by Japan, Australia, and Japan. The key takeaway is that staff continues to monitor these exposures and explore managers with attractive attributes that could be beneficial to the portfolio from a geographic diversification perspective. As it pertains to emerging markets, we are within policy range of 0 to 15%, noting that much of that exposure is China. Also noting that no new investments have been made to China in the past year. Slide 27. Thank you, Mel. In each of the 1, 3, 5, and 10-year periods, we see that private equity has outperformed its benchmark, fulfilling its objective as the primary driver of long returns. Moving to slide 28. As mentioned earlier, the in-house co-investment and secondary program has generated strong performance since inception in 2019, outperforming the core program. Drivers of that include fee savings, there being no J curve as capital is immediately deployed, and most importantly, intentionality in investing. And this really attests to the investment process undertaken by the team, which was formed by David Chu, now comprised of Cheryl Liu, Didier Acevedo, Derek Kong, and Calvin Chang, in sourcing and evaluating deals, ensuring that they meet our investment criteria, and presenting the best opportunities to the full growth investment committee for discussion and debate, and ultimately a vote by all members with final authority to invest resting with CIO John Grable. We know that not every co-investment will be a winner, but we take great comfort in the integrity and consistency of the process. Last comment here, this initiative is very much aligned with the theme of LACERA moving from allocator to investor. Slide 29 shows the estimated $20 million in management fee savings generated by the co-investment and secondary program by avoiding the typical 2% management fee structure. On slide 30, PE seeks to generate the highest performance at an acceptable level of risk. To that end, we constantly look to incorporate any tools that can help us better understand and manage portfolio risk. Staff has started reviewing the Barrow One analytics to gain insights into the illiquid portion of the growth portfolio. The simple takeaway here from the top portion is that private equity is 34% of the asset class weight, or 12.4 of the $36.2 billion, while contributing 44% to the category's total risk score. The bottom section breaks down the components of private equity risk. And as you see, benchmark risk represents the majority of that risk. Questions that we will continue to explore is really how do we use this data to better select and monitor our portfolio on a day-to-day basis? And really, what is the appropriate benchmark as well? If we can move to slide 31, we see that private equity currently stands at 17.7% of the total fund, approximately 700 basis points above its 17% target. In the 2023-24 time period, staff and Stepstone concur that allocating 4 to 5% of plan assets annually to the asset class will allow us to remain close to that 17% target. We note in the bottom left-hand chart there that the in-house co-investment and secondary NAV is projected to grow from its current 8% of the portfolio to approximately 21%. And last point here, we would also point out that with the growth of the program, we will look to increase our fund commitment sizes to more of a $250 to $500 million range. Final note here, Appendix E is footnoted, contains the Stepstone model assumptions behind these calculations. Slide 32. So even as our overweights to US and technology, along with our VC exposure, have helped to drive strong returns over the past several years, as we head towards more global economic turbulence, we remain cognizant of the benefits of diversification to mitigate risk. We will continue to explore structures that can lower costs and enhance returns. On slide 33, and 35 cover the strategic initiatives for private equity and growth. And some of the highlights of the in-process and upcoming initiatives include onboarding the selected managers for the emerging manager programs for both global equity and private equity, continuing to build out total fund climate exposure analysis, and further integrating DEI and ESG into our processes, leveraging the TIDE framework, continuing development of risk analytics tools such as BarrowOne, for private equity, the larger fund commitments, and we will also explore a secondary sale, likely in that $1 billion range. And we'll continue to refine and codify our operational procedures. Slide 36. Staff proposes advancing the following items. First, commit approximately 4 to 5% of trust assets to private equity opportunities annually over the next 2 years. Second is extend the policy range for co-investments, fund to funds, and secondary strategies from the current 10 to 25% to 10 to 30%. So while there are no changes to the CIO delegated authority across the PE program, that is now consolidated into Appendix B5. And finally, reaffirm the global equity investment guidelines, which now include the board-approved emerging manager program policy range of 0 to 10%. Finally, appendices for your reference, the growth guidelines can be found in Appendices A and B. Appendix E, as mentioned, has the assumptions for StepStone's private equity allocation model. The Appendix G has a number of required reports, including private equity commitments made during calendar years 21 and 22 to date, re-ups that LACERA declined, and some anticipated GBs that will be returning to the market during the course of the next 2 years. So with that, staff stands for any questions that the trustees may have.
Thank you, Mr. Simpson. Mr. Knox.
Good morning. Thank you for the information. Good presentation. Back on slide 26, I just wanted to make sure I understood in terms of the underweights that you referenced in Australia and Japan. So is that something then that you're just monitoring, you're actively looking at to, shift some resources there? Just talk to me a little more about that.
Certainly. I would say we certainly are monitoring the underexposures, but I think ultimately the quality of opportunities that are available drive allocation of dollars. So I know one of my colleagues who's covering Asia was recently at the Asian Venture Capital Journals convention in, I believe, Hong Kong. So I know she met with a number of managers, and hopefully, some of the managers will meet the criteria that would allow her to bring those back, conduct a deeper due diligence, and present them to the full team. So I think certainly I think China, as I said, we haven't made any new commitments over the past year. I think in terms of especially Australasia, that's an area we could potentially diversify to.
Thank you.
Great, thank you for that, Mr. Kelly.
Good morning. Thank you for the presentation. It's also good to see everyone again. I had a question about I had a comment actually about the presentation, the written materials. At the beginning, you say we asked your support to do these things, and you referred to other sections in the deck. And it would have been clear for me to just list in the actual memorandum what those were, so I didn't have to go back and look at page 39 or B5 for the delegation. And regarding the delegation, I just want to make sure, because it wasn't clear to me, you're just consolidating the delegation from different sources into one chart. You're not asking for new delegations. Is that correct?
That's exactly correct.
Okay, thank you.
Anybody else? Seeing none, I have a couple questions and a comment. StepStone present, I imagine yes.
That's correct.
Okay, so my questions go to StepStone. The first question I have is whoever is here from StepStone can elaborate a little bit on the BarrowOne new tool that we are using. I'm not familiar with that. And the second question is with regards to the commitment to larger investments, anywhere from 250 million to 500 million. My question there is if you can educate me with regards to the feasibility of being able to deploy that type of capital. And assuming, yeah, that's per deal. So, what's the possibility of being able to deploy that amount of money in the market, what is flush with liquidity, and also if you can discuss a little bit with regards to emerging markets. I see that we overweight in China, but we're looking for other opportunities in the region. But if you can talk to us about other emerging markets such as Latin America, Africa, what opportunities are there, and talk to us a little bit about the currency fluctuation that may hinder our opportunities in the emerging markets.
Mr. Santos, this is Chris
Yes, sir.
talking. The Borrow One program is an internal program here at LACERA that Stepstone does not really has no affiliation with or is working on. So that's strictly a investment office program. So Natalie would not have any comments on that. But what I can tell you is that it's a risk management program that we are trying to use in a better way within the private equity program to identify risks where they are, what we can do to mitigate them. So that's strictly a LACERA initiative is maybe a better word. So if you have any other questions about that, I'd be happy to take them, but that's what I can offer at this point.
Thank you, Mr. Wachter. I appreciate your response. I would request that in the future, this committee be educated in any tools that the staff is using, because we want to be in tune with you. But I appreciate the initiative, and I believe it's Mr. Grable. Does Mr. Grable have a comment? I'm not sure if it's.
Borrow
Yes.
One is a good morning, Mr. Chair, trustees. Borrow One is a total fund tool. We went through an RFP and the board approved using Borrow One for the entire portfolio. It's reflected in the quarterly performance report. There are sections in there. The risk section is based upon that tool. So this is just, we're now, in addition to using it at the total fund level, we're using it within individual asset categories.
Great. Thank you very much for that explanation. That's really helpful.
And hi, Mr. Santos, this is Natalie Walker from Stepstone. I can address the other two questions that you had. So I think the first one was really related to the ability to deploy 250 to 500 million per ticket in the current market. So I think it is a tall order, but your peers have been able to successfully deploy those size commitments. And they've done so by really partnering with some of the largest global private equity firms and really being a strategic partner. So when you look at the dollars that you'd have to put to work per commitment to get kind of preferential either treatment in terms of fees and or be first in line for co-investments, those are the size commitments that you would have to deploy with some of those larger global funds. So certainly doable and actually comes with benefits that I think are consistent with what the strategic plan is trying to achieve, notably, reduce fees and improve performance.
Yeah, so just to follow up on that, Ms. Walker. So what about the mid-markets? My understanding, and correct me if I'm wrong, I haven't reviewed the numbers lately, but my understanding that a lot of the opportunity in private equity is the smaller mid-market opportunities. So what about that?
So I think this is really just increasing the upper limit on the more sizable scaled commitments. So you still be able to invest smaller dollars in mid-market managers and selectively do that with maybe, a handful to a dozen managers at the lower end of the market.
All right, so we're going to be playing in that sector as well. That's great. And well, what about the emerging markets?
Yeah, so I think we addressed some of this during the July board kind of performance review, but I think there continues to be attractive opportunities in each of those markets that you discussed. Acknowledge that LACERA is probably underweight Latin America and Africa. There's a number of opportunities that are actually in market and or coming back to market. There is a manager that's an existing relationship in your portfolio that we've been tracking, David Simpson and our team kind of hand in hand looking at that opportunity as a re-up. That's Vinci, that's based in Brazil. And really trying to assess the performance of that manager as they look to exit more investments. So to date have been kind of light on liquidity back to the plan, and understand there's a number of liquidity events potentially on the horizon. So I think we are taking a hard look at those markets and hopeful that there'll be some improvement to net performance. And certainly currency, as you mentioned, is one factor, but believe over the long term, currency can work itself out if you stay committed to the region. Oh, I think you're on mute.
Sorry, I was coughing. What about now I lost my train of thought. Anyway, one follow-up question to that, and then Ms. Sanchez. So with regards to the emerging markets and in reality globally, the geopolitical challenges that we face, for example, in Brazil, we got new elections in Colombia and other parts of the region. How do you see that vis-a-vis our opportunity to pursue those regions?
Yeah, I mean, what we've seen our clients doing over the last kind of 12 to 24 months is pulling back and retrenching from emerging markets. I would say that we should continue to look at the regions on a case-by-case basis. Obviously, each country region holds its own unique kind of opportunities and challenges, like you mentioned, both geopolitical as well as economic. So kind of assessing each country and region individually.
Great, thank you, Ms. Walker. Ms. Sanchez?
Okay, can you hear me?
Yes.
So I saw that you were using Borrow One, a longtime Borrow One user. Its greatest claim to fame is actually volatility forecasting, which is a terrible risk measure for private equity. So I'm wondering how you're using it or how they have improved the model with regard to liquidity and pacing, and if you're using any other tools to sort of kind of measure your commitments and what that looks like going forward and how that feeds into the decision to expand your target range in order to remain in compliance. 3 questions.
Is that for Ms. Walker, Ms. Sanchez?
Yes, well, for Chris or for.
Sure.
Yeah.
I'll let David answer the bar one because he's more in tune to that than I am. But one of the benefits of the co-investment and secondary program, as David mentioned, is there's no J curve. And so we can get the money in the ground faster and know where our target or where our allocation sits. The problem with funds sometimes is you make a commitment or the board approves a commitment and the manager
it takes 2 years.
It takes 2 years, a year to draw down. So it can get very choppy as far as what our allocations are. But the goal really is to get in the ground each year, the target amount. And what I mean by that is get it invested. So by improving or by increasing the allocation to the secondary and co-investment program, we can do that, and we can better even out our investment amount in private equity. And so that's really what I monitor most and how we measure. We did change from an amount, the committee advancing and the board approving an amount each year, because we think the percentage works better for us, because if we see opportunities, they'll be there. We think, talking to managers now, there'll be some opportunities, next year. I'm not saying we're going to, commit more than the 4 to 5% or come to the board with proposals to commit more than 4 to 5%. But we do monitor those numbers, both, investments in the United States. As you know, we have more allocation there than we have elsewhere. But again, these are blind pools. The managers, make the decisions. They decide when to commit. But the one control we do have is that co-investment and secondary program. So I'll turn it over to David, and he can speak to the
just
borrow.
follow on that. So are you tracking these in a spreadsheet? Are you using Private Eye? What tools are you using to keep track of your commitment schedule?
All of our commitments are tracked we use Burgess Private Eye, and then everything is stored within the Stepstone, or not Stepstone, within the State Street system. And then each investment recommendation we bring to the board, it shows how much we've committed that year. So
I was just curious.
Yep.
Were you wanting to speak?
Mr. Chair, can I?
Absolutely.
Ryan.
Thank you. Just to get to good morning again. Good morning, Ms. Sanchez. The question about borrow one versus size of commitments, I think that they're two distinct things. One is
Yes, I know that.
No, I'm just trying to separate the question. Pardon me if my answer was inartful. The size of our commitments have been more or less static as the size of the fund has grown. And it is becoming a challenge in two ways. One is we may have too many relationships to monitor. And two, each relationship or each investment may be not material to the fund as a whole. So it's important for us to scale, recognizing that something that we discussed during the asset allocation exercise is the importance of taking a barbell approach. So we'll have large commitments potentially, and we'll have smaller commitments to allow us to identify opportunities such as in the middle market that the chair was referencing. As it relates to borrow one, a lot of this is consistent with what is in our strategic initiatives, that we have these tools. We need to use all the tools at our disposal to give the board the best information as the markets are increasingly challenging and it gets harder to earn that 7%. Borrow one has evolved. They certainly, the classic case of it is using it for that volatility measure. They are dedicating, and once again, I don't want this to be a commercial for borrow one, pick whatever total fund risk management tool they have to, in order to be relevant today with illiquids and private assets being ever more material in institutional portfolios. They have to develop modules. So we're trying to evolve with them, or whatever service provider replaces them over time, but we're trying to be much more scientific and intentional in our approach across every asset category.
Okay.
Thank you, Mr. Grable. Any other comment, question? Seeing none, I will entertain a motion to forward this to the Board of Investments for final approval.
This is Keith. I'll move approval of staff recommendations.
I will second that. Roll call.
Mr. Knox?
Aye.
Thank you. Mr. Jones?
Aye.
Thank you. Mr. Santos?
Yes.
Thank you. And Mr. Green?
Aye.
Thank you. The motion passes unanimously.
Thank you.
Thank you very much.
Great, thank you very much. Items for staff review, I believe we have none. Items for future agenda,
We don't have anything.
okay. Good of the order, anyone?
Okay.
I don't see anyone. I have a comment. I'd really like to commend the staff for the well-written presentation and memo. It was thorough and easy to read. I really enjoyed it, quite frankly, reading the material this morning. And I just can't help but to think back about 20 years ago when I first got elected. You know, a lot of my constituents told me, keep an eye on the boogeyman, which is named private equity. When I came into the board, I came in with a kind of like a mandate to eliminate private equity from a portfolio because it was evil. And what I did, like a typical lawyer, is you don't just listen to people opinion with regards to a particular issue. You just dive in and study it, and that's what I have done since I've been here. And I discovered early on, last 15 years ago, that private equity actually was not the boogeyman, but it's actually a great strategy for us to accomplish what we need to accomplish for our members. And it is really exciting for me to see the changes that we have made into private equity, the fact that we increased the allocation, the co-investing. It is just outstanding and music to my ears because it is a good program. And the fact is that the staff and the consultants have been able to implement the program in a very good way. So I am very happy. I commend the staff for the tremendous work that has been done both in the public equity as well as the private equity. Obviously, I'm a little biased in favor of private equity. And also to my colleagues on the board for being open-minded and paying attention and making the changes that we are making and we move forward. So this is, to me, a great day, not only because we had a great election last night, as far as I'm concerned, my district flipped to the Democratic. It's a great pickup for the House. So I just feel really energetic today, given what happened last night and this great news with the private equity. So anyway, fantastic work, staff. You are the best. Anything else? Anybody else? Hearing none, I will entertain a motion to adjourn.
So moved.
Thank you. And we'll be ready to roll by 9 a.m. on time for the BOI meeting.
Sounds
Thank you.
good. Thank you.